All right. Welcome back, everybody. Get another week started. So we got a lot of uncertainty out there. It's pretty obvious. The markets have no idea. There's no forward outlook. The global markets have no idea. So this really kind of crimps the longer term trade, right? The day-to-day stuff, yeah, I mean that never changes, right? We've always got something to play on the daily. It's just the swings that are going to continue to stay in this perpetual cycle of uncertainty. Eventually that will change, but in the meantime, stay nimble, know what you own. Right now, the market's looking for a new narrative. If we're going to rotate into a new money cycle or rotate out of a cycle, if we're going back into growth and out of value, then there's got to be a narrative that goes with it. So that's what we want to continue to look for. Not a lot going on today other than the market still digesting what happened last week. We have Christine Lagarde in the United States. She's supposed to be speaking today at 1:30, and of course that opens the door for additional volatility and remarks. So keep your eye on the clock. The Nasdaq is down the most, then the small caps, S&P, the Dow, Hong Kong, Japan up just barely 0.25%. It doesn't really match that market wave that we focus on, right? With Australia and then Asia, Europe, and us. That's the cycle of markets that open around the world. We have a number of Fed speakers today chipping their teeth. They're not expected to really say anything new. It's just beating the drum with the same old hymn book. And we're going to get factory orders, but the number really, as far off as it is, we're going from 2.7 to basically zero. That is a significant shift. But we want to see what comes out of this. The main thing is the numbers are really wide. So we want to see how that gets resolved. If you take a look at FedWatch right now, they're not really offering any direction. Kind of goes back to what I said at the start of this stream about the uncertainty and the lack of forward guidance. The markets have no idea. And if you're new to trading and you're not used to anything else, then of course this probably seems normal. But if you've been doing this for a while, you know that we could have a lot of structure and forward guidance that really provides clarity on what's going on and what we're looking for in the future. And without that, the entire thing just becomes a lot more difficult. So the solution isn't just to sit out. Of course, you can just sit out, avoid the whole thing. You could just trade ETFs, right? There's nothing wrong with just buying some SPY or Qs and walking away for a while. But the other solution is to just dial back your position size, right? Tasty Trade's motto: trade small, trade often. CTA positioning, you can see that we're below the zero line, so they're still lightening up. White House risk today, it's below half. So when we're looking at this, do we have any, any risk coming out of the White House? Yeah, a little bit. The main thing that I see in this is the pre-ceremonial media coverage. That opens the door for the president to get asked some gotcha questions, for him to make statements off the cuff that could be misinterpreted. There's all kinds of ways that that can go wrong. So that's sort of the biggest risk that I see from this 10 a.m. remembrance ceremony. The call wall rolled down. So um, if you look at the picture I shared, it rolled down to a previous level that it had rolled down to before. The call wall has basically been moving in a sort of a range. So it was running at one spot, then it rolled up to another, then it rolled back down, and then it rolled back up, and now it rolled back down again. Not really all that exciting. If it breaks the current low and rolls down yet again, then that would be more impactful, probably provide more insight. But where it's at now, rolling just right back down to the previous level, not much to work with on that. Wouldn't get too excited with it at this point. But we can see the call wall and the put wall. It's a 200-point range, and everything is tied up inside of that range. You look out here on the daily, we've got the 3, 10, 20, 50 call wall, put wall, volatility trigger, zero gamma, the 10-week, all wrapped up in there all together. That's what happens when you go sideways. Everything starts to tangle up, right? We still haven't resolved that issue from last week. So we got the high and lower high. We've got this low, which was a new low. So a low, a newer low, newer low. Then we put that in. So now we got a higher low, but we don't have a resolution to this yet. This is still a complex topping pattern. Something needs to break. At some point, we know it's going to. No reason to put any bias into this and think that we can anticipate the directional outcome. But really, we don't have to. Right? All we got to do is wait for the break, play whichever direction it takes. Until then, as long as the market is in this range, the broader market is going to be in that perpetual state of unknown. And of course, when we zoom out, you can see the broader range that we've been focused on, whether you take it all the way back to October, November, or you bring in the smaller ranges since then. But this is what we've been working with. And since the new year, we've been tightened up in this smaller range. But we are in the upper part of this smaller range. And that might not account for much, but it's better than nothing. So as long as we're still holding above 6,800, then we're still in the more positive area of this range. I know it doesn't really provide that warm, fuzzy feeling we're all looking for. 79,000 in the overnight. So the participation last night wasn't any different than what we saw a lot throughout the week last week. We were running in the high 80s, high 90s. The average is in the 50s. So we've certainly got market participation. And last week, we were getting that volume without China, right? Remember, they were on holiday. So even without their participation, we was able to hit our average plus some. Certainly no lack of market participants at this point. The ADR really hasn't shrank that much, even though we've been sitting sideways over the last week. We dropped it back down below 100, but just barely. So we're at 98. If you round and run averages like I do, it's basically 100. But it is getting lower. It's trending in the right direction, I guess, if we want to see everything kind of lose that volatility that we've been seeing. We got an old market phrase, well, old enough, I suppose, since I'm the one that started the phrase. If we get to one side early enough in the day, we can go to the other side by the end of the day. If you're not used to this, you may take that as a bullish statement. I'm not bullish. Yes, we would have to go up to hit that other side. But that's merely a function of the way price moves in a wave, right? So yeah, we'd have to go up. Yes, going up could be considered bullish. It doesn't owe us that move. We could get that just as a part of price making its wave, right? Kind of just come out here and look at how price moves, right? It's a wave. So when we're at the bottom of the wave, there's kind of nowhere to go but up. That's why you don't want to short from the hole. And when you're at the top of the wave, you don't want to try to go higher. That's why we don't try to, get long at the ceiling. So we've reached the lower ADR. We did it early enough in the day. The day is half done, so the clock is ticking. We're running out of time, but we did get down there early enough that we could get to the other side today by the end of the day. The problem is we're stuck in this range that we've been developing for over a week, and we need to get the heck out of the range, right? GTFO, we got to get out of the box. So right now the focus is our own Globex range. Kind of take these one at a time. So that's our Globex range. Then we've got yesterday's RTH, which happens to be all of yesterday because the Globex was inside it. If we can get out of our Globex range to the upside, it's not much of a move to get past the 69.32 cog line, Friday's high, and get that breakout with a chance to get into 69.70, this ADR half up here. To the downside, we're already underneath the Globex midpoint, so we got to get through yesterday's midpoint. It's where we're getting this reversal bar right here. It's possible reversal. It's actually starting to look a little bit like it could be a swing low pattern. Get through that mid, challenge our low, which is also the ADR half again. I know the line doesn't go all the way across, but it's just the platform. If I was using TradingView or one of the others, the line would go all the way across. So you don't see it there from last night, but it was there. If we get through that ADR, just going back to the ADR at this point, after having already gone down there and hitting it and moving away from it, if we go back to it now and hit it, it's very likely we'll go completely through it and target the next ADR level. So this is the ADR half, that's the ADR full. To understand that, think about the ADR being 100 points. Half of the ADR is 50 points. Half full. So from where we opened last night, if we go half one direction and half another, we've got 100 points between those two red lines. Because that's what the market generally does, right? It goes down, goes up, goes down, and goes up. But if we get really bullish, we could move a full ADR higher. And if we get really bearish, we could move a full ADR lower, rather than splitting it and going half and half. Kind of the idea, right? Pretty simple concept. So break our Globex low, break Friday's low, then get the full ADR. Then we would look for 67.50 because we're running 50s. And a breakout of Friday's low would get us below 68.50. So we'd be looking for 67.50. Today's floor pivot is higher than yesterday's. That's bullish. Price opened above it. That's also bullish. We've already come down and hit it, so it doesn't owe us a move down. We don't have to go down and get the floor pivot closed. It's no MDP or anything like that. We cut underneath it and came back up through it, but then we got back down underneath it again. That's not usually a good sign. Typically, you stay above it or you stay below it, or you cross through once and then you're done with it. Crossing back and forth through that kind of suggests we're going to get another sideways day where we're just dancing around these levels. Now, of course, news can break all of that and throw everything out the window because we had news. But that would be some sort of gotcha news, not something off of the economic calendar, because what we have on the economic calendar today doesn't look like it's got the juice to get us outside of this box on its own. So it's always possible that we'll get some catalyst headline that we didn't see coming and get out the box. Otherwise, making that sort of crossover back and forth below the daily really highlights the idea that we're going to hang around here and not make it through there today. It would be different if we were focused on this floor pivot and price had cut up and down through it, staying near it. That would be completely different, right? Even getting to the top of the channel like it did here, or the bottom of the channel like it did there, that would be still the idea that we're just sitting there crossing back and forth through that pivot. But what we did was different. We expanded significantly away from the pivot and then came back up into it, and we still wasn't able to hold it, and now we're working our way back down again. Because of the multiple days last week of us going sideways, the S&R levels are going to be a lot closer than they generally would be. Wow, that R level's really far away. The indicator is a little smart. It's not like AI smart or something like that, but this is the range that I just measured, the distance from the floor pivot to the S1. But you can see R1 way up here. All of this is an extra space, so they're not equidistant. how far we go to R1 versus how far we go to S1. The indicator is highlighting that there's more room to the upside than there is the downside, which kind of implies it's more likely we go up than down. Just keep in mind that this indicator doesn't make price do anything. All right, so it's not going to make price go up. It doesn't make us go down or stay in a range or do anything else. It's just giving us some insight on what's more likely. The indicator is highlighting that path of least resistance, it's more likely that we go up into 69.50 than that we go down and break that 68.70 that we've already tested once this morning. There's also the old logic of S1 R2. That would put us all the way up here. And we've already talked about how the ADR half low has been hit, and we did it early enough in the day that we could go to the ADR high half by the end of the day. So we got multiple things suggesting that a breakout is possible to the upside. Not a breakout and run. Nothing suggesting that we're going to, get above 7,000 and just keep on going. But getting to the upper ADR half or to R1, both would require an inside day breakout of Friday's high. Yeah, you like it. The CPR channel's a bit wide, Central Pivot Range CPR. When we have a wide channel, it implies that if we break out, it likely doesn't stick and we come back inside again. Now, what it's talking about breaking out of is yesterday's high and yesterday's low. So first, we'd have to get there. We got to get to the high or the low of yesterday, and then break out beyond that level. And then the indicator says it's likely that we don't keep that breakout and we just come right back inside again. That kind of suits. It's what we've been doing, right? Getting those breakouts and they don't hold and we just come back in and we're sitting in this range forever. So status quo, I suppose. Got a interesting distribution. Well, it's interesting to me. I'm a bit of a nerd. We didn't do much last week, right? Classic D-shaped distribution. It thinned out in the lower half, right? Below that, say, 68.32 cog line, we really started to lose it. We've tested last week's point of control in the overnight. We're still holding above it, but at the moment, we got nothing, right? We're sitting in the same value area as last week. We did have an upper level distribution here. We wasn't able to keep it, and we've already come back in. You can see where we ran up and hit that and rejected. It does get thin. So if we lose this value area low, it's likely that we can travel through this zone relatively quick. It's because there's no structure there to hold us up. Ten-day, 30-minute volume profile and TPO. I think the TPO is doing a really good job of highlighting our two distributions. You can see we got our work cut out for us if we can get out of this lower value area. It's like 69.50. If we can cut above that, we've got this another area of distribution. That's just a lot of trash sitting over our head. But for the moment, we're kind of gravitated around this point of control. But it does thin out before it starts to rebuild itself. And as the week goes by, we're going to lose a lot of this that's over our head, right? A lot of this is going to be gone. So how long is it going to take? By Friday, it'll all be gone, and we'll be in a much narrower range if we don't get back up there sooner than that, right? We just pull this across, you can see it gets a lot narrower, right? That's about 150 points right there, which is pretty narrow for a 10-day range. Of course, it won't take much to lose that. All we got to do is expand below 6,800 or get back up above 6,950, which is what we've been talking about all morning, is the likelihood that we break Friday's high and we expand up into that 6,950 and challenge the 7,000 level. Friday, we took out that VPOC from Wednesday, so we're done with it. But we did build a new VPOC on Friday. So we're just dragging that level across. Now we got a new VPOC from the 20th. I don't zoom in and try to get it to the tick perfect. You do you if you want to zoom in and do that, whatever. The textbooks will tell you to carry all three of these lines forward into the next trading day. I've got enough pivots. I'm really not interested in doing that. And really, I just carry forward the ones that have not been hit yet. So for an example, I was carrying the one from Wednesday. We held it all day through Thursday, and we never hit it, so it didn't matter. On Friday in the pre-market, we still had not hit it, so we were still carrying it. And then sometime after the open yesterday, we ran up, or on Friday, we ran up and we hit it. So now we're done with it. But I don't take it off on the day we hit it. I leave it on there throughout the day just to see if we're going to continue to interact at that level. We didn't. We went right through it, but you don't know, right? Which is kind of the whole idea. This morning, we don't have much. This is really ugly. So we're not getting a lot of insight into this. Just multiple distributions all over the place. Now on Friday, we were examining this week's range, and we were comparing it against the week that we were experiencing last week. This range is derived by two pieces of data. One is volatility, and two is time. Let's swap this back to the ES. Now the options data has this expected range move, right? That particular indicator doesn't exactly reach out and grab this data, but that's what it's supposed to be doing, right? Thinkorswim doesn't give us any access to this number in a code. So the guy who created that indicator, Mobius, he found a way to replicate this number without actually getting it from this spot. I don't know how he did it. He's a freaking wizard at this stuff. But you can hand draw the levels, right? But that's where it comes from. But this number comes from active trades that are happening here in the options chain. So it's not like a moving average or a MACD or something like that that's looking at old price action or old volume. something like that. This is looking at live trades that are still being held. It's looking at how those trades came in, how fast they hit, how big the trades were when they did hit, the frequency of those hits. And it's using the out of the money options on the put side and the out of the money options on the call side, and it's averaging those strikes implied volatility into this volatility average up here. And then it gives us this plus and minus range. As you can see, it's alive, it's moving. We don't want that. We want the one that was locked into place, and that's where those levels are coming from. They're using Friday's levels locked into place after the close. So it's based on the trader's idea of what the market was going to do this week. Not what they said, but what they traded, right? Follow the money. So if the market participants were expecting a sideways week, their trades would have reflected it, and we would have a much narrower box. If they thought that this week was going to be violent with a possibility of big expansion, they would have traded it the other way, and we'd have much wider range for the week. Last week's range was a 4-day week. This week's range is a 5-day week, and yet this week's range is narrower than last week's range. So we have more days and we're traveling less. That's like doing 60 miles in 45 minutes and doing 45 miles in 1 hour. You would think if we had more time, we could travel farther. So the market is anticipating less volatility this week than last week. It's hard to quantify because there's a day different, but the range is narrower. Even if we just ignore days for a minute, this week's range is narrower than last week's. That means less volatility, less movement is anticipated. Then add another day to it, and it implies even narrower range. So it doesn't look like much, this little difference, but it's a lot bigger than that. This is the first week in a while that the market has priced in a narrower range for the week. We've been getting big range weeks for a few months. These narrower ranges, when they get priced in, nearly always reflect an economic schedule. FOMC, CPI, PPI, non-farm payrolls, all of those can cause a narrow week range. The market sees this big economic event on the calendar coming up. They anticipate will go sideways into that event, which then makes it a volatility suppressing situation. Because it's a narrower week, keep your eye on that 0 gamma level. If we cut below 0 gamma, and right now just going above and below the 0 gamma in this sort of a zone, it doesn't put us into that regime where below 0 gamma they sell into selling and they buy into buying. We won't get into that regime if we're just whipping back and forth through this level. But if we cut below that level today and we continue to expand below it, say tomorrow, below 68.50, and then we get a little lower, we start getting closer to that put wall. If we get below 0 gamma like that and challenge that put wall, and then we've got that narrow range for the week, and we get below, say, 68.11 cog line or the week's low, we can start moving very fast to the downside. And we've talked about 67.50 a number of times because we've come down and challenged that level multiple times back in December and then early February. If we cut through the week's low today, tomorrow, we could get down into 67 or 66.50 real fast. So just be mindful of that. A lotto that far out of the money should be crazy cheap. But it just like going to the gas station and buying a scratch lottery ticket, there's, a 1 in 10 million chance you're actually going to win any big money. That's why the risk is so cheap, right? Where else could you spend $2 and win $1 million other than a snowball's chance in hell, right? The odds are not in your favor. That's why it's so cheap. So if you're going to try to buy some lottery ticket YOLO play, keep it cheap, right? There's nothing wrong with buying that lottery ticket, spending $2 or $5 for a chance for us to go to 6650 or 6600. But don't put real money behind that because there's no reason to do that, right? It's not a high conviction trade. It's just a big risk looming on the horizon. And that's the primer that we're in at the moment. That if we start to break down because of the current situation, that drop could be violent and significant. We're still holding out at the 10-day, so we're basically in the center of the basketball court. We could move 1.5% to 2% up or down from here, and we still wouldn't be overbought or oversold. Same thing with the 10-week. We're just here. We're on it. We could move 2.5% to 3% up or down away from that 10-week, and we still wouldn't be overbought or oversold. We got nothing at the moment. The only good thing about it is like we just filled up at the gas station. The car's got a full tank of gas, or you just pulled your phone off the charger, full battery. We got all the energy we need. Now we just got to go somewhere. Looking at what's down this morning. Bitcoin, the Mag 7 up volume is down. Expanded tech, UFO, uranium, chips, robots, China, Mag 7, generic tech, banks, finance. Looking at what's up this morning. The Mag 7 down volume is up, and gold miners, junior gold miners, really that's it. So not even precious metals really, just the miners. And nat gas and VIX. Now VIX is up 7.25, but over a 5-day period, it's only up 1%. Coming up off of a support level, apparently. %51 of the NASDAQ 100 is down 0.5%. That's not exactly a bullish backdrop, yeah? And 3% of the NASDAQ is up 0.5%. So we got a lot of negative, not a lot that is positive. %45 of the S&P is down 0.5% this morning. And of course, we can see those Mag 7 names. Got Amazon and Meta, A lot of semiconductors in there, packaged software, which isn't really a surprise because software continues to get the beat down. Some transports. Quite a number of big banks, financial institutions. So it's pretty nasty out there and it's diverse. If we're going to turn around, we would need something that changes the narrative for a lot of different sectors and industries. Now, a headline can do that. Some 0-day flows could do it, but we can't really rally in the broader market and get a breakout in the S&P and the Nasdaq if we don't have the Mag 7 working with us. Now, if they just go sideways and they don't hurt us, then yeah, it's possible we can get that breakout without them. But we can't go against them. So if they're going down, the best we can do is not go down. Certainly can't go up. The range is set. It's a really clear range. It's not bad at all. So far, everything is really clean. And we just got to get out of this box. So you got the levels. Run it till it breaks. Look for the breakout. I think the downside's the cleaner one to play. Level wise, right? Because you got nice clean levels to the downside. But the ADR half and R1 both suggest we're going to get that breakout above 69.30 and get into 69.50. So if we break this pivot, then aim for Globex high, get through that, we aim for Friday's high, and we get past that, we got 69.50. Level by level by level, right? Destination trading 101. Keep going. That's what I got for you guys. Be careful, be safe, watch the clock today. I see y'all tomorrow.